I think the market is currently pricing in around 90 basis points of cuts for next year. And the median dot plot, as you say, from June was around 100 basis points. So the market is already anticipating potentially that hawkish tweak, if you like. But then also we have to remember the 2023 dot plot and just the signal that they keep that one extra hike in there, which is highly likely because of the resilience that we've seen in the economy, in the data, for sure.
I would say if they actually remove that one for 2023, it would be a dovish surprise as opposed to the status quo being a hawkish surprise.
Absolutely, yeah. Hugely.
When it comes to rate cuts, though, what are you expecting? Because it is interesting to see how resilient the U.S. economy has been. They don't need to cut rates at this point. So why is the market anticipating it next year?
Well, I think for sure the economy has been resilient, and that surprised so many people. So for sure Powell will acknowledge that fact. GDP, I think the Atlanta GDP nowcast forecasting for Q3 around 4.9%. So for sure growth will be strong. But of course their mandate is not GDP growth. It's about inflation and full employment, and for sure in inflation, we are getting good news, encouraging news, and that's what I guess the market is focusing on, and potentially then there are more headwinds going forward sort of into next year. Multiple headwinds sort of near term, with the potential UAW strike and obviously the government shutdown. But then further out, the sort of wider picture is for tightening financial conditions, which then means higher borrowing costs, less credit availability, and there are other issues around that.
It's the same playbook for other central banks out there, but I think your point about the U.S. economy and the momentum the next couple of months is going to be a bit more challenging because of the shutdown, the strikes, signs of more softness in the labor market. I want to turn and talk about markets and the price action that we've seen, particularly in yields. They keep moving higher. 10-year yields now sitting at, I think, the highest level for this cycle, so the highest level we've seen since 2007. What do you think is going on there? Why has there been such a remarkable reaction in bond yields the last couple of weeks?
Again, I think we just step back to the economic resilience that the US is showing, for sure, and also then with that, obviously markets anticipating this higher for longer narrative, which the Fed has been talking about for some time now, and obviously markets hadn't been predicting that and have been looking for cuts, but now that the sort of market view has converged with that Fed narrative about being higher for longer, and that's what we're seeing in the 10-year Treasury, as you say.
Well, some people were saying that in addition to the economic projections and today's decision, their estimate of the neutral rate further out is also going to be key. Because if they do downgrade that, then perhaps that could be a dovish signal, and perhaps that could be a catalyst for U.S. Treasury yields to start coming back again. What's your view?
Yeah, I think there's actually been chatter about that possibly going higher. So from the 2.5% neutral rate that we see at the moment to possibly 2 3/4, and then 3%. And that's, there's again a number of factors with that longer rate, but I think important is just the fiscal loosening we've obviously seen in the previous administration, and then obviously as well the current one, and then that means that the monetary policy needs to be more restrictive, obviously, to rein in inflation. I think the fiscal deficit projection is around 6% until 2025, so for sure that potentially pushes prices up over the long end. And then we also have wider macro factors, actually, which I think are quite interesting about deglobalization, of course, decarbonisation, and the slowing birth rate.